This is Super Investors in the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
This episode is brought to you by the Felder Report. Each week I go through a ton of reading and research. In fact, that's pretty much what I do for a living. Every week I cultivate or curate, is probably a better word, a couple of things, 5 things to be precise, that I found during the week, whether those be charts or links that I found most valuable. So I put those together into a free weekend email. If you're interested in reading something like that, just go to thefelderreport.com. Right there on the homepage. You can sign up and you'll be good to go. My guest for this episode is Keith McCullough. At first blush, Keith might come off as just another brash and cocksure trader. Dig a bit deeper, though, and you'll find a calculating iconoclast driven by a deep desire to both continually improve as an investor and ultimately change Wall Street for the better. After starting in a job running buy and sell tickets, Keith worked his way up to running a portfolio and eventually to founding his own hedge fund. Today he runs Hedgeye, a research service established with the goal of giving individual investors a look behind the curtain of a major macro hedge fund environment. In this conversation, Keith discusses how he developed his 4-quadrant macro framework that informs all of his investing decisions and how he uses it today. He also reveals how volatility can be used as a buy or sell signal and how getting fired taught him the greatest life lesson of all, to bet on himself. So without further ado, please enjoy my conversation with Keith McCullough.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep, and sheep get slaughtered.
Keith, welcome to the show.
Thanks for having me. I was looking forward to this, Jesse.
Yeah, I'm really glad to have the opportunity to chat with you. I have to, I've been thinking about putting together questions and stuff to ask you. And the first thing that I have to ask you about is it seems like you have a, probably to a lot of people, you have kind of a penchant for conflict. And 2 of my closest friends are Canadians. They seem to prove the cliche that Canadians are overly friendly, almost too nice. You, on the other hand, would appear to many to probably be the exception to that rule, at least on Twitter. What is it that draws you to conflict, or at least compels you to confrontation?
Well, I think your Canadian friends I'm assuming that they weren't Canadian hockey players, because they definitely have some kind of an agitating component to their game, or they'd seek conflict to some degree. But I mince no words on this. I think when you're disrupting what I affectionately call the old wall, or old Wall Street, and a lot of the different things that people have as either received wisdoms or part of a process that they think is a process. I have a lot to say on that, and I think that the only way you can really get to the heart of the matter is to speak bluntly or factually, and especially when it's in response to someone that's trying to reduce me to short term or this, that, or the other. I think it's an opportunity also to frankly market that there is a better way. I believe that. I have a passion for this. I've built my career on this, and I'm going to keep fighting the good fight.
Well, it's funny because somebody, I put out a tweet. I said, "Hey, I'm interviewing Keith. What do you want me to ask him?" Somebody put out a reply that said that as a hockey player, you took as much pride in racking up penalty minutes as you did scoring goals. Is that true? First of all, and second of all, does that reflect your personality kind of on and off the ice?
Well, I didn't take a lot of pride in my penalty minutes. It was usually a function of me being, overly aggressive, or as my dad would say, you're the kind of player that needs to play on the edge, but if you go too far one way or the other, you're not going to be effective at all. And I think that's who I am. I certainly won't apologize for who I am, and I'm not going to change who I am. That's how I like to play the game. And I think if you play the game aggressively and you can play it your own way, there's plenty of history across a lot of different kinds of professions, never mind our own. I just think that in our profession, people are a little bit more likely to be a little bit more polite, I suppose, or a little bit more establishment, and that's the way that it might feel to some people.
Yeah, interesting. It's certainly a change of pace from what you see on CNBC or whatnot. To me, in thinking about this, one of the things I've noticed is kind of alongside a rise in kind of tribalism in politics, there's been this kind of growing tribalism in the markets too, where it used to be that you'd say, "Hey, I'm bullish on this or that," and you're bearish. That's what makes a market. And there was kind of you'd at least have some respect for the other side. It seems today that there's like there isn't that respect that if you're bullish on something, the other side is just idiots. And so I think do you see that at all? And is that maybe part of this confronting people's is there are both sides to every trade, and to have that humility and respect for the other side is a healthy thing.
Yeah, I mean, for me, I have a lot of respect for repeatable process that's accurate over long periods of time. That I have plenty of time for. That's why we've had real conversations on Hedgeye TV. I think I've got a plenty long track record to show all the people that have played the game at a high level and played it across cycles. I think is the most important thing, certainly relative to how I play the game, because I consider myself, which I made up basically as a full cycle investor, and getting the full investment cycle right isn't always subject to huge debate. I think that what you're talking about is more interesting, and I think you called it tribalism, and that's certainly the way that it appears to me is if you like, I have a very consistent ability to trigger people, and I'm not trying to. In fact, I'll trigger people that are bullish on gold for 2 years, bullishly. And now that I recently sold all my gold miners and shorted them and then started selling gold, then I'll trigger those same people negatively. And I think that that's something that, whether it's your politics or it's your feelings and relationships in your life, really we're at a point, ideologically or politically and viscerally, where people really are one way or the other. And that's just not who I am. I mean, I go both ways, Jesse, and I like it, and I talk about it, and I go both ways because the cycle does. It's just the rates of change in the cycle, as you know, growth accelerates and it decelerates, and inflation accelerates and then it decelerates. And that 100% of the time will reflect the direction that I'm invested in. And I'm happy to get in any debate about that part of the process. I mean, I just think that when you're being reduced to name calling or whatever, I don't think that anybody's really trying to understand what you're talking about. They're just trying to say you suck because you don't love what they love forever.
Well, that's to me, I don't really, I'm kind of the opposite. I try and avoid, these Twitter debates and types of things. But for me, it's fascinating to watch, because when people do attack you and just name call, it can be a fantastic sentiment signal, right? I mean, when people actually don't have any interest in actually debating your position and just want to trash you as an idiot, to me, that's one of the best sentiment signals out there. But you make a good point too, that a lot of this tribalism comes down to people aren't willing to recognize that there's a time to be bullish, a time to be bearish. And, for most of these people, they're perma bullish or perma bearish on whatever it is. And so when you change from, being positive to negative on something, it triggers them.
Yeah. And I think that's all a function of the times that we're in. I mean, you really have, as we've talked about it quite a bit. I mean, and I think it's a very healthy thing. You have participation in markets, and I mean broadly now, if you include certainly the more one way, if you will, directionally group of people out there, which would be the Bitcoin maxis. I think gold is like an older crowd. Maybe they're less engaged. I don't know. But I mean, it's you have participation or supply of opinions with a channel that is Twitter, that is 24/7. So participation's great. I live in the world of being macro aware and data dependent, apolitical. These types of words don't always fit with large arenas of participation, where there may not be, from my perspective, an awareness from a macro perspective or a historical time series perspective or the cycles perspective. And I think that a lot of those things for me are opportunities on the educational front. And I will try to, I'm not always being the aggressor. I do think that there's a great opportunity in educating people about what I think they prefer to be aware. I mean, risks are omnipresent, and I think that people would prefer to be aware than unaware.
Absolutely, and I mean, uh, there's pros and cons to handling it, in a variety of different ways. I'm curious as to how did you, we talked about you went to Yale, played hockey. Where was it that you first became interested in markets?
It was my first internship on Wall Street. I was working for a gentleman by the name of David Williams, or his nickname is Tiger Williams, not the hockey player on the NHL side, but he was a former Yale hockey captain. So like most, or I shouldn't say most, but a lot of us, I was fortunate to be, associated with a connection where I got that internship. And that's where I really found, like, up until that point, I'm just a guy from Thunder Bay, Ontario. I'm not going to reduce my life to like being part of some class. I was quite happy. My dad was my dad was a firefighter. My mom was a teacher, and I show up in at Yale on campus. I thought that this was like the industrial mecca of the world. I mean, so by the time I had this Wall Street internship, I wrote a book about it. Actually, I was completely a fish out of water. I'm wearing my like junior hockey Canadian like outfits, silk shirts with like I guess the eagle went over well with the Americans with these bald eagle ties and stuff like this. It was just kind of funny and I guess embarrassing. But I did fall in love with the pace of it. I love keeping score, of course. The time stamping that I always talk about was really a function of my first job on Wall Street, Jesse, which is, I'm sure you remember these times, but like I had a timestamp machine, and I had black tickets and I had red tickets. And since we traded only for hedge funds, we were basically like an outsourced trading desk. All I was doing all day long was taking like long and short tickets and time stamping them for guys like Ken Griffin from Blue Ridge, who was just starting his fund then. Tiger, they call him Tiger too, as well, because he was the head trader for Tiger Management. And he started his own company. Still to this day, it's still called Williams Trading. But I loved it. I loved seeing how people made decisions. How I was really interested in the real game within the game, which is the real debate, which is, you see a smart person put in a buy ticket, and at the same time somebody's putting in the red ticket, the sell ticket. So that's when I got into it, and I never looked back.
Well, yeah, I started running tickets myself, so I know that feeling in that time period. So this guy Williams, did he approach you and say, I really think that this career would suit you, or did you approach him and say, this is something I think I'd be good at?
He was very active in recruiting Yale hockey players. And he'd tell you that hockey players are of a certain mindset, and I think you're going to work hard and you're going to learn it quickly, and you'd enjoy this, and I did. From there, I became an analyst on Wall Street, and I also had the ability to trade. So some people try to like it's a bad word, like, oh, you dirty trader, you. Like, it's not. I just know how to trade. I mean, if you could be a long-term investor that knew how to trade, wouldn't you? If you could be a long-term anything, wouldn't you prefer to have more skills? I mean, that to me, those days were foundational, suffice to say, in terms of both the behavioral side of the game and actually executing on it. So, I was very fortunate to have that experience that Tiger gave me.
And so how did you get from there to Hedgeye? Walk me through that time frame.
Well, I went from my first job on Wall Street, because that was an internship. My first job on Wall Street was on the big trading desk in the big, on the big floor at Credit Suisse. That was prior to the DLJ merger in 1999. And I did my rotation, the program. Basically, you get hired on as a newbie, and you learn, what's going on the trading floor. Back then, it was the IPO bubble craze, so I was, literally pulling reds out of the mailroom. Again, just reading prospectuses and trying to get the 5 or 10, whatever, bringing in the morning. I was on the hedge fund desk, and I was basically telling some of the more, I guess, relevant investors in the world what I thought was going on with each and every one of these companies with no experience whatsoever. So I did get a pretty quick crash course. I'd stay there till the lights would go off, and I'd be first in the morning. That was kind of my thing. Like, if you can just outwork people, that might mind the gap or close the gap between people with experience and knowledge, which I had none. And that worked. So different hedge funds were interested in hiring me as a junior analyst, and then that's how I was on my way. By the year 2000, I became an analyst, a consumer analyst at a hedge fund that was called Dawson Sandberg, that then was splitting up into Pequot Capital and what became Dawson Giamalva and then Dawson Herman. So I was very lucky I was one of the first people, as an analyst at a hedge fund that was effectively starting anew. And up until, to make a long story short, they gave me my own book, quote unquote, carve out of the fund. Did really well with that. Ended up starting my own fund in '06 with a guy by the name of Harry Schwefel, who subsequently became CIO of Point72. And then I went to, when we split ways, he went there. I went to Carlyle when Carlyle, the private equity firm, was launching their hedge fund in '07. They hired me to run a long short equity. And I thought it was the greatest job on earth. And 6 months into it, we blew up the hedge fund. Our credit guys did. So everyone got fired. I got let go earlier, because a little earlier than most. On November the 2nd, 2007, I got fired for being too bearish. That was an interesting time to get fired for being too bearish. Of course, the S&P was down 6%, I think, in November of '07, and never went up again, really, up until April of '09. So I started Hedgeye basically because I got fired, Jesse. So I had a non-compete and started Hedgeye at the end of '07, blogging about my trading my own personal accounts. And actually, that's what I'm still doing today. I'm still doing it with a lot more firepower and analytical bandwidth, and a much better process. Wow, did I not know what I didn't know from a macro perspective back then than I do today?
Well, I mean, we're all constantly learning. If you're not, you're in trouble. And so, I mean, that's why I'm doing this right now, is why I do the podcast, is to be constantly learning. So you started Hedgeye partly because of the non-compete, but really, what was the impetus? What were you trying to accomplish? Was it just, to give people an inside look as to what you were doing? I mean, was there a bigger impetus there?
Yeah, I always found the dynamic, the cultural dynamic in the hedge fund community interesting, and one that I felt like there was an opportunity to take advantage of. Like, for at least when I was in the hedge fund business, it was dog eat dog. The hedge funds, those two words together, were largely considered by the outside world as bad words. Even on Wall Street, they're probably considered bad words unless they were your clients. So what I wanted to do, like anything I've ever done, is play the game out loud and say, okay, look, what if you had a world-class hedge fund that everybody could look inside? That's why I called it Hedgeye, like if you could look inside. So the transparency component is embedded in the name Hedgeye. I thought about that for a long time, and have it transparent, accountable, and trustworthy in a way that, quite literally, everything you did, okay, you're going to make a lot of mistakes, you're going to have a lot of wins too, but from a process perspective, everybody could really battle test why you're making the decisions that you're making. And to me, that's been, if I have a blessing in life, it's been able to, for 13 years now, much like you just said, like, I get to learn the game out loud. I get to build this place alongside tremendously talented professionals that have been on Wall Street, in some cases for a long time, in some cases for no time at all, and they're learning from all of us. And we have this great learning ecosystem. I guess, as Peter Senge, who wrote The Fifth Discipline, would call it, we have a learning organization. And that's to me right now the biggest opportunity, is that we're learning faster, we're failing faster. It's okay to do that in life. You should fail fast. That's the only way you learn. And my community of power users and people that love me and hate me and everything else, it's only making us stronger. It's making the what I thought we should build in the beginning, which is, again, if you could look inside of it, what would you see? I think people are liking what they see a lot more than what I could have ever imagined have started to build back when I started.
Well, yeah, I mean, that was going to be my next question. Is you said you basically started just blogging about how you were trading,
yep.
And obviously Hedgeye has grown a lot over that time. How has the product itself changed, over the past 10 years?
Well, I mean, the stock picking component, which is what I did in the first part of my career. I mean, and we have 40 different analysts that, have longer term views. And that's where, like, I completely disagree with the label of being a trader. I can risk manage and trade around core positions, which are intermediate to long term in nature. Those are the specific words to define what we do. And that was exactly what I did with Harry. Like, we would take very concentrated positions with a 2 to 3 year view, and we would trade them actively. that's what real hedge funds do. I mean, if you do it really well, by the way, the guy who's Harry's boss, owns the New York Mets right now for a reason. I mean, there's a profitable way to if something's going from 10 to 15, I don't want to make $5. I want to make 7 or 8 or 10. And that's really like on that side of it, we built that out. So now, in the Hedgeye in the future state, God willing, we'll have upwards of 100 analysts instead of 40. We'll cover every single sector. But over the years in between then and here, basically what I committed the rest of the most recent, component of my life learning or professional learnings to is this macro research process, which largely augments your ability to pick sectors, countries, sectors, and ultimately stocks. And, we got into that, a while back, but now I think we're doing a much better job communicating what the 4-quadrant process is or what the full cycle investing process is. So now what we ultimately have is basically a top to bottom or bottom up stock picking and top down macro. It's fully integrated of what I call a full investing cycle process.
Well, and I want to get into the quadrants. Before I do, I want to come back to something you said though about trading. How hedge fund is kind of a phrase that people look down upon, but so is trading, right? And to me, I think about I started studying trading a long time ago because I realized quickly, as a value investor, I'm going to run into a ton of value traps if I don't figure out, kind of a trading overlay that's going to prevent me from buying some of these things that don't work out. Why do you think it is, I guess, that so many people look down upon trading even as just an overlay to a bigger macro or fundamental process?
I think it makes them feel better about themselves. I mean, I think
Yeah.
that's that's life, right? I mean, if you are of a certain way and somebody's of a different way, there are long histories to suggest that people like to say that we're right and you're over here, and that's okay. I'm totally. If anything, I'm one of the people in life that's been battle tested for that. My whole life, I've been told that I'm not good enough or wasn't going to make it, and now if with the macro process that we have, that I put intermediate to long term and immediate term, all 3 durations that really matter in macro, understanding the long cycle, the intermediate term, cyclical moves, and also the short term trades. If reducing that to Keith McCullough as a trader, then I have a lot of runway of opportunity because my competition has no idea what I actually do. So that's a good thing, I think. But another way to put it is, an investor is just a short term trader that's underwater. People like if you could, you would. If your first trade was always right, you would. And that's just not reality. So I think a lot of people are more comfortable saying, well, I'm longer term. I don't have to. It just makes them feel better.
Yeah, and it probably does come back to what we were talking about before, that kind of tribalism that people are not only just perma bullish or perma bearish on something, they're buy and hold in that thing rather than being flexible. And so anybody who is flexible is wrong, is an idiot. Let's get into this. You have this model that's made up of 4 quadrants. First of all, before we get into the model itself, where did it come from? I guess, how did you first develop this model?
Well, I started, everything starts with experience, right? Most things, unbeknownst to, I guess, the textbook people or the people that think that economies and markets work like they do in your Econ 101 textbook. And, I'm well versed in that. I have a degree from a school in New Haven that teaches that coherently. At the end of the day, that's not the way that the real world is. I mean, you learn by doing, and I learned how to model companies using what we would call, Harry and I would eventually call, when we started Falcon Hedge Partners, which is our hedge fund, the 3-pod process. So instead of the quads, and we still talk about the 3 pods today internally, 3 pods being pod number 1 is revenue, and it's all rate of change driven. So revenue, are you accelerating or decelerating revenues, cash flows or earnings is pod number 2, and then pod number 3 is your capital allocation. So those 3 pods are still today what, if you ask any of my analysts, or if you listen to any of our, now I let people subscribe to our morning meetings so they can listen to it in the flesh. I mean, this is what we talk about. We talk about accelerations and decels and revs and cash flows. And that's where it came from. So I said, hey, why don't we build this out for macro, where I basically substitute revenues with GDP and I substitute cash flows or earnings with inflation, because that's what's going to drive, the cost of living, for example, in that economy. And that's where it started. It started with a model that I'd used successfully and applied materially in public markets, and then started to build it out. And lo and behold, it started to work. It had, again, it took until, it was kind of interesting and humbling that when Ray Dalio wrote Principles, and before people lose it, oh, he's calling himself Ray Dalio. I'm not. I mean, I actually think we're better than he is today, because we're bolted to the chair. This is a job that requires 4:30 wake ups every morning, late nights, and you got to do it and do it and do it, and you got to grind and grind and grind, because it's a data intensive business that requires a lot of bean counting. So it isn't exactly something that you can do when you're 99 years old. It's something that you have to be committed to doing every single day. And that's where I'm at today. Now we do 50 different countries, Jesse, as I'm sure you're aware. So what's most interesting is measuring and mapping, which we can go through the 4 quadrants in a place like Mexico, or a place like Indonesia, a place where I don't have a long track record of being successful on the investing side, because I've been around for enough, 20 or 40 years doing it with this model. But I'm quite excited about the next 20 years of my career to apply, what we've done basically with the G20 countries to the next 30 countries after that.
Yeah, absolutely. And so just do me a favor. And so the 3 pods again are revenue, cash flow, and I lost the last one.
Capital allocation. So
capital allocation.
Yeah. How is the company's free cash flow marrying up to their returns on invested capital? And should they or should they not reinvest in the business or buy back stock, et cetera?
And so translating that to the macro framework is, revenues to our, GDPs essentially. Cash flow is, did you say inflation?
Inflation. And so I only use, and for the, what would be pod 3, we call this our GIP model: growth, inflation. So the equivalent of revenues and cash flows are growth and inflation. And instead of capital allocation, we use government policy. So it's called our GIP model, or GIP model. When I reverse it, it's perfect for governments, because it's our pig model. So basically governments are very predictable. When we see the rate of change of growth and inflation slow at the same time, which is quad 4, governments 100% of the time print money and devalue or try to devalue the currency. So we're front running the growth and inflation, front run not only what asset allocation you should have in what country, what sectors you should be in, long and short, what stocks and styles, high beta, low beta, high, big cap, small cap, et cetera. But they also front run the central bank. And that's why this model is so valuable. Because for a long time, people said, well, but the Fed, you can't fight the Fed. It's like, I know that's a Wall Street talking point. So let's just park that over there in that parking lot. I like to park actually at the far back corner of our own parking lot, because I like to get in more steps in a day. So I've always parked in a different place. So let's just not talk about fighting the Fed. Let's talk about front running the Fed. Let's have a model that, again, causally understands not only asset returns, but the behavior of the central bank.
Well, and the central banks have taught us that they're very predictable, right? They're going to, when GDP does X, they're going to do Y. And so that's not super difficult, but I think, what's important is to have this kind of a framework so that you are prepared for how things are evolving. So talk me through, I guess, the 4 quadrants, and so those would be GDP rate of change, inflation rate of change, government policy in some sort of a rate of change. And then say the 4th one again.
That's it. Well, those are the 3 factors.
The 3.
Gotcha. The model so if you were to look at our 4 quadrant model, it's a 2x2 model, just using growth and inflation. And again, the modeling premise is, as I always say, The Secret to the Universe, or In Infinite Powers, which is a great math book that everybody should read by Steven Strogatz. He called it that, so I borrowed that. I like to borrow things from great one-liners. You love that. The Secret to the Universe is calculus. Like, how many storytellers on Wall Street know that? They prefer their narratives over the numbers, of course. But if you take your 2x2 model, you got your growth and inflation, you got 4 scenarios in rate of change. You have quad 1, where you have the rate of change of inflation is slowing and the real growth is accelerating. That's the best for humanity, never mind value as an investing style, which to a lot of people is now their humanity. Quad 2 is when growth and inflation, the cycle's more obviously accelerating to more people. So both growth and inflation are accelerating at the same time. So quad 2 is when even the financials go up. So, again, if you're a value buyer coming out of what I'll get to quad 4, you're going to really get paid there because interest rates go up, gold real rates go up, gold goes down, treasuries, long-term treasuries go down. So what we've done is we've also back tested each quad against everything that you could have an opinion on. That's why I have so many opinions that can trigger people. Quad 3 is where you have economic stagflation, or you have the rate of change of inflation is accelerating, and real growth, unfortunately for the people, is slowing. That's actually been the modal outcome for a lot of central banking activities over the intermediate to longer term. And then, of course, there's quad 4, which is the danger zone, where you have neither growth nor inflation accelerating because both growth and inflation are decelerating. That's called deflation. So now we have a convenient way to talk about specifically and mathematically daily. You get daily data points on these things. And, we run predictive tracking algorithms to measure and map it daily every day. There's no opinion on that. I'm just making it loud about, and using these things that we've called quad 1, quad 2, quad 3, and quad 4, and back tested literally everything against it. And to me, that's tremendously valuable macro awareness for people if they didn't have it in the past.
Absolutely. And I think that is, what distinguishes your process from so many other things, right? I mean, so most people don't even have any type of a framework for understanding where we are in the cycle. Now, talk me through, I guess, how we've gone through the quadrants, I guess, from maybe a year ago, to today.
I guess the easiest way for people maybe that haven't heard this before to think about it is where were you, like, draw a sine curve on a piece of paper so that it's there mentally as well. For me, my challenge is all I think about is rate of change and where are you on the sine curve, and most importantly, where are you going next. So you can identifiably put in, let's use the U.S. economy. It peaked in Q3 of 2018. The U.S. economic cycle peaked in rate of change terms. So that means that GDP growth on a year-over-year basis peaked at 3.3%, which is a little higher than where it's peaked over prior cycles because we had pro-cyclical tax reform. I could go through all the different reasons why. I don't really care why. I care less and less why the older and fatter I get, really. But that's, you put a dot, that was the peak of the cycle. The first quad 4 was actually in Q4 of 2018, which you'll recall was a shit show basically for most people that were long everything and unaware. That was also a great time when the cycle peaks to start to buy things like long dated treasury bonds, gold, housing stocks, things of that nature that are rate sensitive to the downside. So that cycle, the peak of the sine curve, Jesse, was Q3 of 2018. The low of the economic cycle was during the very short recession that started in Q2 of 2020. So everything in between is rate of change, quad 3 and quad 4 slowing to that point. All COVID did was it accelerated and pulled forward the bottom of the sine curve, or the bottom of the economic cycle.
Okay. So now we are in, is it quad 1 where growth and inflation are going to start rising again?
Yeah, well, quad two is where we have that. So for the next 2 quarters, we're now casting growth and inflation accelerating quad 2, which is why it took me 2 years, but I basically sold, and now I'm going to short the things that I was long, and those include treasuries, gold, utility stocks. Because again, we back tested every single quad against everything that ticks, which we can get into. Can tickle the fancy of certain Bitcoiners, or it can but it's a back test. And back tests don't lie. People do.
Yeah. And so, I mean, so that quad informs your investing clearly.
100%. Like, don't start anywhere else. Whereas, like, I wouldn't that's where I start. Think of it like a fish finder. So this is, if we're competent fishermen, we have all the equipment, we have a great fish finder, we have all the rigs and gear and great boat, and we know where to go. That doesn't mean we're going to have a great day on the lake. But if we can really zero that in, at least we know what lake we're going to. Let's start with that. The locals would know that anyway. So locally, I want to know what I could catch here. And that is, I'm only interested in buying things that go up in quad 2 and selling things short that go down in quad 2.
And then, so with this macro framework, do you apply kind of that micro framework that inspired it? You go back to that revenue rate of change, cash flow, to look for individual stock ideas?
100%. That's exactly, well, most important, I focused our analysts on doing that. So, doing what we do on the macro team is obviously a full-time job, doing this across 50 countries now. But now I'm pushing I just push. I push the analysts to get out of ideas that worked in quad 4, for example. In quad 4, like as I mentioned, utilities work, consumer staples work, housing stocks work. So pushing the analysts to not only get us out of those as full cycle investors, again, trying to realize a return in a housing stock from, if you bought them, just go back and look at the returns, Q4 of 18 and start selling them now, you'd be very, very happy. You'll be very unhappy if you don't sell housing stocks and the US 10-year yield busts a move to 1.5% or 2%. And that's, so I'm trying to get my analysts to give me, okay, what are the housing shorts that would, back to the pods, that would show a revenue deceleration with margin compression. And there are going to be a lot of housing stocks that actually do that, and housing related stocks. Like Home Depot, for example, has basically what we call the base effects, the revenue comparisons in Q2 of 2020. Like, forget about it. They're only going to slow against that. So we know that. The question is, timing the stock right on the short side, because everybody owns it. And in a momentum market like this, and with a lot of retail investors chasing names that they quote unquote know, like they're all like Peter Lynch, there's big opportunity in timing these things right. But you gotta do a lot of bean counting on those revenues and cash flow lines to time it right.
Well, that's interesting to me that, there's the fundamental side of it, right? Understanding how those things are evolving. But I'm also curious to know, what is the trading framework that you overlay? Are there are obviously trading rules that you use, to help with the timing.
Yeah, especially on the shorts. On the shorts, I use a series of rules. If something is signaling higher highs, and it's been a bullish trend, again, just to use Home Depot, for example, it's been a great stock, and it should have been a great stock. I think when investors look back across the full investing cycle, a lot of what I'm saying about the rates of change of growth and inflation really tell you the real story on why you did or did not get paid on your stock pick. For a long time now, and this irritates people as well, I call people Captain Stock Picker or macro tourist. Why? Well, because that's who I was. I was completely unaware from a macro perspective. I was confusing my stock picking ability with the cycle. You got to be really careful with that. So if something continues to signal higher highs, and it could even be a fraud. We've seen that in this market where companies are potentially frauds, and they'll make all-time highs despite that. They'll make all-time highs despite anything. So we use that as a good stop loss rule. Don't even get involved until the bloody thing starts signaling in rate of change terms lower highs. People are going to say, well, how do you do that? Well, we have a thing called the risk range process that a lot of people subscribe to, that shows you the daily range. And quite simply, if the top end of the range is a lower high than the prior one, now we have an interesting entry point to start to consider a variety of strategies, either shorting the stock outright or starting to look at buying puts or a series of options, depending on what the catalyst is in terms of timing for that short.
Yeah, that's very interesting to me, because one of the simplest things I think, would be, and most important things investors should learn is just how to appraise momentum, right? You find a cheap stock you want to buy. If it has really strong downward momentum, you probably want to wait a little while. Is that kind of, these risk ranges, do they kind of help identify momentum to try and understand like where you are in that trend?
Yes. And thanks for asking that, because that's like, if I take my day, like my workload in my day, between 4:30 in the morning and 11 Eastern, I spend 80-20 rule at least 80% of the time trying to answer the question that you just asked me. The other part of the time, like getting the cycle right, to me is actually, it's hard work, but it's not hard to comprehend once you're on a path. The hard thing to get right is timing securities right down to the screws, like to a small cap gold mining stock on the short side. That's tough. So you gotta be very aware of the volatility of the thing that we're talking about. So I measure and map every single thing that moves on a 3-factor basis using the simplest of models that I use. Market timing model. Bad words for people. Some people say market timing, that's evil. Traders bad. And what they really mean by that is that they're probably bad at that, or they haven't really tried it. It's actually a lot of fun because you fail fast and you get better over time. But price, the 3 factors are price, volume, and volatility. And it's really overweight. It's an overweight on the third thing, the volatility of the price. Because if the volatility of the price undergoes what I call a phase transition from down volatility to up volatility, then that's the beginning of the end for that stock price or that ETF price or that whatever it is, that security. And that's where we spend a lot of time. I mean, this is basically, you're into the thralls of Fractalhood or Benoit Mandelbrot when you're starting to think about, what is episodic and non-trending volatility, or what is the beginning, a beautiful beginning of a fractal, or a similar set that gives birth to a new trend. And that's what we're always looking for, because trends trend. And the turns or phase transitions, as you call them in anything else in life, something thermodynamic or whatever, you want to boil a frog, go for it. I mean, it's you want to identify phase transitions because that's where things that have gone down for a long period of time go up, and then they start to go up faster, and then they go up for a longer period of time, and vice versa. Things that have gone up for a long period of time start to go down a little bit, then they go down all at once, and then they go down for a long period of time. And that's why I take great pride in being called a shorter term or longer term, because I think if you can do that right over the course of your career, and I'm talking about 20, 40, 50 years, you're going to be much happier than with the alternative.
Well, that reminds me of a quote from Paul Tudor Jones. I think it was from Market Wizards that really resonated with me the first time I read it, which, he says, I think most traders are trying to catch the meat of the move. They're trying to trend follow. And they say you can't really, catch turns. And he said, well, I've spent the last 10 years, catching the turns. And so, me, that as a kind of a natural contrarian, I'm always looking for the turns. And so my question to you, I guess, is about what do you look for in terms of volatility, right? In terms of price ranges and volume, those things can kind of, you can see patterns, but what do you look for specifically in terms of volatility to understand where you are in the trend?
Well, first of all, you have to have a framework like anything else, like the 4-quad process. I have 3 regimes of volatility that I really care about. One is investable volatility. So investable, like a certified monkey, and you'll find plenty of them on CNBC, can make money picking stocks. That's when the VIX we'll use the VIX. U.S. equity volatility is a simple example. When the VIX is between 9 and somewhere in the mid-teens, 15, let's say 9 to 15 or 16, then again, a certified banjo playing monkey can pick the stock, buy every damn dip, and make money, right? Where the monkey gets in trouble is the moving monkey, I call it affectionately, and some people get upset by that, but it's okay. We're all learning here. When you move in from that phase into phase transition and what I call the chop, you're like into the high teens and the high 20s is the next regime of volatility. That's a tradable, what we call the chop bucket, or the tradable regime. You go from investable to tradable to the wrong bucket, which I've a variety of names. One's got 4 letters and starts with F, and that F bucket is north of 30 vol, or VIX in this case, using this example. Everybody dies, big time. Like if you came into that hurricane, and again, you should use things in natural life space as the example. Like when you're going from chop vol or second regime vol to phase 3 into that bucket, it's just like a hurricane or an avalanche. If you're not prepared at the particular point, as Mandelbrot would say, that the risk comes on, then you lose a lot of money with a lot of other people all at the same time. And those are the places that Tudor Jones has made a lot of money on the short side. I have too. And conversely, when you come out of that bucket and you tip back into the chop and then you're heading towards investable vol, you make a ton of money across the full investing cycle. That's why, again, bring this full circle. What I'm really trying to do is have the vol of vol, as Mandelbrot would say, or anybody who's adept in studying markets from a fractal perspective. The vol of vol, or the volatility of volatility, front runs the next phase transition. The phase transition is the next economic regime or the quads. So that's why I always say my signal front runs the quads.
So you run the vol of volatility on individual stocks then?
Yep. And that's where it's much more fun because the bands are much different. I just gave you a simple one with the VIX, but if you want to use something like even Apple volatility, I mean, currently it's in the high 30s to low 40s, and it's actually a chop, what we call the chop bucket for Apple. That's tradable with a bullish bias, and once it's not, it's going to be outright shortable with a bearish bias, and that's when Apple vol would have to break out into the mid 50s is where its wrong bucket is, and you can actually go back and look, back check me on that. I mean, I back tested everything. Nothing that comes out of my mouth, nothing that comes out of my mouth has not been back tested. If it does come out of my mouth and it hasn't been back tested, my team's listening to this right now and they're back testing it.
Yeah.
Because again, I want to be specific. I don't want to be, ranting with narratives on what could, should, or would happen. I want to talk about what happens to Apple when it gets into this volatility regime, and what happens, if it's 54, say, or higher. That's where people die.
Yeah, that's fascinating for me to hear that. I think people who, some of the biggest blow-ups I've seen in markets are people who go into short selling without a process. And, I've had Bill Fleckenstein on the podcast a couple times before, and he talks about having a framework around short selling, which I want to shoot these things in the back. I don't want to be a hero and shoot them when they're soaring. And to me that's kind of what you're doing with this volatility framework, is saying there's a time to when it's safe to short these things. Otherwise, I don't want to step in front of them.
Yeah, sure. Let's start with what not to do. And I'm sure Bill's learned these lessons over time. He didn't think that way all the time. Nobody has. You have to short things with live ammo to learn how to short things. Okay, so again, what not to do? Don't short something on valuation alone. The reality is that it's getting more expensive, for example, because pod 1 revenues are about to accelerate at a faster rate, and pod 2 cash flows are going to accelerate in kind. Great example this year is Zoom, or pick any stock that we liked that was the recipient in a positive way of the COVID pandemic. So you don't short those until we get closer to when they have to cycle against that. And guess who knows that first? Well, it's the volatility signal, not you. So we know when Zoom has their toughest comparisons, Q2 of 2021. So now the clock's on. So now Zoom's got to prove, and we just sold it. I did, in terms of that's a good example of a stock that I didn't care what the price or the valuation was. And when I say that, some people pull their hair out because they went to business school and they were taught, well, it's so expensive, it can't do this anymore. Well, it does do this. And so I think about the what not to do. Don't short on valuation. Don't short a certain sector or style or stock that's got positive 1 month and 3 month price momentum when it's along in that economic quad or quad 2. Like if you're shorting an energy stock right now, you need your head read. It's got positive 1 going on 3 month price momentum, which the machine loves. It has falling volatility, and it's along in quad 2. So again, when I think about ideas, I think a lot of them, like in terms of I think a lot of, Jesse, about my battle scars and what not to do. And that's why my process is re-engineered to not make the same mistakes over and over again.
Absolutely. And I mean, that's how, we make progress in anything. Is hopefully we learn it from our mistakes. I want to come back to also this individual stock selection too, because that's really kind of what I'm most curious about. I love that there's the macro framework for it. But you mentioned Zoom, for example, the revenue growth rate is going to start to decelerate. When do you? I mean, you've targeted. What would you say? Q2 of next year or Q1 of next year? That's going to. So when do you anticipate the market starts to discount that? I mean, how do you factor that in?
Well, the market. I mean, this part. I mean, it's not. As a younger band, let's just start with that, or as a younger bear. I would want to run down there and short everything I could all at the same time because I knew that was coming. Well, that's wrong. It's okay to let the market let you know when it's okay, and that's really what I think about. So Zoom's upcoming quarter, it's actually today they're going to report. We have first of all, we have an analyst with their own model on it. We've been right on the numbers for a while now on the upside. What I really want to hear is him come off that conference call and tell me for the first time where the rate of change on his earnings upside tilts in rate of change terms to the downside, not negative revenue growth. Again, making up numbers, let's say you grew 100% revenue growth and then you grew 200% revenue growth. What I really want to hear from him is what quarter they're going to grow 175% revenue growth, because that's the first sequential rate of change. Now, you might, if they say that on the conference call, you might miss the first 20% of the move, but you're not going to wear the last 80% of the ramp up your, on the short side. Because you can, once you determine that the rate of change is decelerating, a great short right now is Netflix. Like, we know Netflix is going to decel from now until they lap those COVID comps in Q1 and Q2 of next year. So that's an easy short. I mean, they've already told us that. So the stock makes lower highs every day, not randomly. It's doing that in an up market because the market's got it right. So I'm okay with having some patience in the last 1 to 3 months on a short, and that's usually the toughest window, the last 1 to 3 months, because that's really what the market's really telling you over time on that is that the market's very good at front running the first or the initial deceleration from an epic acceleration in revenues.
Well, a lot of these stay-at-home stocks, it's curious to me that you're looking at Zoom and Netflix. Peloton is another one that comes to mind that, that probably pulled forward just a ton of demand, for the last 12 months. And it seems like they probably have a demand black hole at some point in the future. So that's what the analysts are looking at and trying to find that decel. And, then you factor in the valuations, which have gone totally nuts. And, the price, reconciliation on the decel could be dramatic. So,
yeah. And you wait in particular for tech cycles. This is only the third one that I'll be so fortunate to be able to short when it comes, time to do so. Tech broadly. For now, tech is along in the quad that we're in, quad 2, but systematically certain names are becoming shorts. That's where there's what we call asymmetry in your long short portfolio. That's awesome. But it's also the beginning of the end for the big thing, which is everything else. And it's an interesting thing with tech and communications, because the non-COVID recipients, like take boring, old or smaller cap tech, all of the above, I mean, they really still have easy comparisons because they slowed during COVID. And so that's where you got this yin and yang within the sector factor. But finding individual names inside of it has always been our bailiwick, so we stick with that.
Yeah. Yeah, I want to come back to, you mentioned Benoit Mandelbrot a couple of times. How is he? Clearly, he's been an influence on your thinking. What is it? I guess what was most important about his work, or what has had the biggest impact on your process about it?
I mean, in a lot of ways. I mean, he was at Yale when all the linear econs, I'll call them, to be respectful, were at Yale. The guy was considered a little nuts for a reason. Because he just thought differently, but he really thought about it from a practitioner's perspective. So from the initial days where he took IBM's mainframe computers and basically just studied the prices of everything from cotton on back again in the commodity space, to just really study what is the relationship between price and signal. And what he came to conclude is, much like in fractal math, it's the same thing. Similar sets develop, causal factors. And when they develop for real, it makes volatility not episodic and non-trending, which volatility or phase transition typically is, but it makes it the beautiful new beginning of something new. And that's you have to wait a lot of time to find those, because most of the time, what Mandelbrot also observed, which is very much consistent with natural life, is that there's a lot of Brownian motion, or there's a lot of nothingness. There's a lot of fake there's a lot of fake news. God knows that in this day and age, but there's a lot of non-signal, and that to me spoke to me in a lot of different ways, because I really didn't pay attention to him until 2006 when I was starting my fund, my hedge fund, and then throughout '07 when I was thinking about what am I going to do with Hedgeye and how am I going to articulate the process. And I always thought in rate of change terms, so this really gave me a volatility component to that, and a real human one, one that I can be a humble servant to, and not telling the signal what to do, but waiting on it and waiting and waiting and waiting. A lot of this game across the full investing cycle is just doing that. It's having the patience, to actually wait for something that's real and new.
Yeah, I mean, it's such a great point. I wrote a blog post recently, just from when you study, all these guys, who've been incredibly successful over long periods of time, whether it's Warren Buffett or Jim Rogers or anybody, they all say that just that very thing, that you have to learn how to do nothing, right? You have to learn how to just be patient and wait for those opportunities that come around. It's fascinating to me that you've found a kind of a technical signal to help you, with that process.
Yeah, I think and a lot of people ask me about how did you build the signal? I mean, it's all there in his book. But like in everything in life too, I mean, it's I think Picasso said this, and I'm certainly not Picasso, but it's not what you're looking at, it's what you see. And there are some explicit examples in the misbehavior of markets where Mandelbrot will give you, if you're paying attention and how to model things from a volatility perspective, his rescaled range analysis, for example, where you can build such a good signal relative to what you might be using today. And that, to me, I humbly submit that, and I know it agitates some people, Jesse, but I really don't just make fun of moving monkeys in jest. I used to use them, What I'm using today just makes that look like a horse or a buggy whip or both relative to the machines we're running today. And it's thanks to Mandelbrot. I mean, he really nailed it.
And I read the book just more recently than you did. I think it was just a few years ago. And there's concepts that you come across in your life that just resonate with you. For me, when I first came across the margin of safety concept, that makes perfect sense. The fractal side of things from Mandelbrot to me was like, oh my God, yeah. You look at things across different time frames, and the patterns that emerge are just stunning and undeniable. So it's fascinating stuff.
I think margin of safety. You mean Klarman, right?
Well, he titled the book, Margin of Safety, after the Ben Graham concept. It dates back to Ben Graham probably stole it from somebody too. So it's just. But I've taken up a ton of your time, Keith. I got one final question for you, and this actually comes from a good friend of mine, who's a much better interviewer than I am. He wanted me to ask you: is there anywhere in your life that you've had a key lesson, whether it's through your Wall Street experience, through hockey, anything in between, like a life lesson that's really stuck with you and shaped your decision making?
Yeah, definitely. Getting fired on November the 2nd of 2007. I for those of you that haven't been fired, I'd say that I'd recommend it. In particular, if it's for reasons that give you an opportunity to find yourself. I mean, to me, it really gave me an opportunity to bet on myself in the most meaningful way I could as a professional, which is I literally took a third of what I'd made at that point on Wall Street and invested it all in Hedgeye. I'm the only investor, initially the only investor. We've never really had outside investors, but it was really that point where, if you can't trust your quote unquote partners to be there and to bet on you when you need it the most, and you got to do that and bet on yourself. I see a lot of people in this day and age, they got political opinions and they got professional opinions, but who really wants to be the change that we're whining about here? And that, to me, being a solution or trying to be, being, like I said, a learning organization, externally and internally. If I didn't have that, somebody has to give you that opportunity. They got to punch you in the face. They got to fire you. I got sent home with a box, on a train on that day in 07, and I'm forever grateful for it.
That's, a great point. And yeah, I mean, it's an experience that clearly has had an impact, and the way that you viewed it, it clearly had a positive impact. Where can people who want to learn more about Keith McCullough, where can they go online?
Hedgeye.com, and we have a lot of these things that I've been. Sometimes I think that my greatest challenge, and God willing, I'm going to be able to do it, but sometimes my greatest challenge is communicating the process, and also just that it's constantly evolving. Always learning new things. But most of the nomenclature and terms that I pointed out, Jesse, are on the Hedgeye edu tab on our website. And I think for people that want to really learn, or really, I like it when they think that we might be wrong about certain components of this. I mean, really engage with that. I mean, that to me would be it's a great honor when people read about our process there and battle test it, and we get to engage in the debate.
Well, yeah, I recommend everybody go check it out and follow Keith on Twitter if you're looking for some edutainment in terms of the markets and whatnot. This has been terrific, Keith. I'm really grateful to you. I've really appreciated getting to understand you a little bit better, your process a little bit better. Thanks for taking the time.
Yeah, thank you for taking the time. It was a great conversation. I appreciate it.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.